So, hello everyone. Welcome to this special lecture on climate change and COVID-19. I'm delighted that this was an initiative from the students of the MSc Climate Change Management and Finance at Imperial College, which is a master's, which is a collaboration between the Grantham Institute and the Business School at Imperial College. And so we're joined by lecturers on the masters who will be addressing different parts of the problems and questions that arise from this really very special situation we're all in. So thank you for joining us, and we'll start with Martin Siegert. Martin is professor and co-director of the Grantham Institute and a glaciologist. And thank you, Martin.
Thank you, Mirabel. So I thought it would be a good idea just to set the scene a little bit, because so much has changed in just a short time and very recently. And I think it's going to be a good idea just to go back over the last few weeks and just to check the things that have happened at the timeline they have happened. Okay, click the button, please, Mirabel.
Yeah. Yeah.
So the first, of course, I'd like to mention is, and the next one, thank you, is that it was just the 27th of February, it's a little more than 6 weeks ago, that the government was defeated on the appeal for the Heathrow expansion runway 3. And the reason for that is because it's a large piece of infrastructure and it wasn't compliant with zero carbon by 2050. Just a couple of weeks after that was the 11th of March budget. Now, I'll put this graph of number of coronavirus cases in the UK, starting on the 31st January, and then up to the more or less the present day. And you can see, while 27th of February and the 11th of March, there really wasn't much going on, but we did know about it, and cases were being reported, and it was getting into the news. Next slide, next click, please. Just about 10 days later, on the 27th of March, we hit the lockdown. So over 4 weeks, we went from a remarkable phase where we were talking about the zero carbon transition, the legally binding commitments, a budget that looked very good for future commitments, to just 10 or so days later where we locked ourselves down. Next slide, please. So let's recap on what that budget said. It was an amazing budget from a Conservative government, pushing huge amounts of investment into public services, 100 billion, infrastructure, 600 billion, green priorities, 5.2 billion, and a Bank of England measures at that time, because COVID-19 was happening, being reduced from base rate of 0.75% down to 2.25%. Next slide. Let's say a week later, the Bank of England reduces that bank rate even further to unprecedented 0.1%. And in London at that time, 40 underground stations were closing. So there's like an immediate reaction to the development of COVID-19, both from the Bank of England and from others, but still with the legacy of that very recent budget. And then just a few days later, the lockdown, 22nd of March, which led William Keegan in The Guardian to say, and this is his quote, "The coronavirus outbreak has made the budget irrelevant." So that's quite remarkable. 11 days after the budget, and some people are thinking that that amazing investment in our future has now become irrelevant. And I think today, part of what we're going to discuss is the merit of that statement, and whether it's true, and what consequences will be if it is or if it isn't. Next slide. So it's important to realize that the coronavirus is a deadly serious issue, and many people have been affected by it, and we should understand that. One of the reasons for why so much action was taken so quickly was because of Neil Ferguson's work from Imperial College. And this is a graph that was pushed around about 20th of March, before the lockdown. But essentially, this is what made the lockdown so rapid and so important. It gives the number of cases, critical care beds that will be needed, that are anticipated in epidemiological models, based on doing nothing, which is the black line, to doing a whole series of things. The red bar at the bottom is the UK's capability as it was at that time. And this essentially provoked government immediately into locking down the UK very, very quickly, because it's quite obvious that we simply did not have the capacity in any way to cope with this outbreak in the way that it was looking like in the models. Next please. And of course, you know, and I know that that's exactly what happened, and Britain was locked down, and all the papers have been reporting this ever since. Okay, next slide. So, and this is where we are. Please, next slide, Mirabel. So the number of cases is going up daily. We heard reports today that another, sadly, 800 deaths in the United Kingdom. This is coronavirus deaths with a linear y-axis plotted against others. The lockdown date is the rectangle on the bottom, and you can see it's very reassuring that lockdowns in many countries happen relatively quickly, and essentially we're all tracking on a very similar path, with the exception of Germany, which has which we now know has a lot of testing that's going on. But Spain, France, United States, Italy, and the UK are roughly tracking along the same sort of pathway. Next slide, please. And every day, the Financial Times comes up with another graph, a different y-axis. This is a logarithmic y-axis, and the reason that they have a logarithmic y-axis is you can look at the acceleration of the cases in terms of the dotted lines are in terms of doubling the deaths every day, every 2 days, every 3 days, and so on. And it looked like the pathway most countries was on was a doubling of coronavirus deaths every 3 days or every 2 days or so. And when people say flattening out the curve, this is what they mean, is flattening out this curve so that it becomes horizontal. That doesn't mean things are improving too much. It just means the number of new cases is not increasing each day. And that's what all countries are really trying to do. And you can see in the United Kingdom, we're up among, sadly, some of the worst performing countries in this measure, which is very alarming. Next, please. So, although we can put a measure on the 11th of March budget, it's a bit of an open question as to what the solutions are going to be to COVID-19, because Rishi Sunak, the Chancellor, made a whole series of interventions in terms of keeping people in their jobs, bailing out companies, and it's very difficult to see what the cost of that is, because it feels like it's a bit of an open check. However, what we do know is that under estimates that there will be a financial downturn as a consequence of this, and this came out just a few days ago, and the Bank of England expects there to be an uplift shortly after in the latter part of 2020. The big question we've got is how much it is going to cost us to limit the downturn, and can we recoup quickly the amount of money that it has cost us on the other side of this year. And that remains an open question, but it's something that, of course, for us is really important. Next slide. Now, you would have also heard in the news, there are potentially positive aspects to this whole amazing global issue. And one is that the awareness of the quality of air in many places is improving. And this is the nitrogen dioxide emissions over northern Italy in just a few days from before the lockdown to afterwards. You can see, obviously, there is an air quality improvement. But we have to understand that COVID-19 is hopefully time limited. It's very restricted in its time. It might be a year or so. People have also spoken about the fact that this might have a positive impact on reductions in carbon dioxide, so maybe 5% or so. But this is a graph which shows the gigatons of carbon dioxide that's being emitted for the last 30 years. And it shows at the top what a 1% or a 5% reduction in carbon dioxide emissions is going to look like this year in the scheme of things. And you can see it's really not much at all. It's, I know that Yuri Vogel in a second is going to take this on. So my take home from this, next slide please, Emil, is that there is some good news around the coronavirus. It shows that the world can take action together. We can adopt initiatives which are similar to each other. We can talk to each other. We know that when something serious happens, funds are available to solve the major problems. And also we know that action can be taken based on science to alleviate major problems which are coming up, to make them better than they would otherwise be. And a lot of this has a narrative around climate change as well. The bad news, of course, is that open question: have we spent the funds necessary to invest in that carbon transition? Is the bank now empty? A return to normal, a normal economy, and often politicians talk about returning to normal. It can't possibly be that way because the future has to be zero carbon. And so we have to get ourselves around the fact that returning to the old ways is not a sustainable way forward. We have to think about a different thing. So we have to start thinking about zero carbon transition right now. And while it was pleasing that in The Independent yesterday was saying that 48% of people in the UK believe that similar type of action should be taken to solve climate change, again, what we have to do is test the fact that this COVID-19 crisis will go on for some more weeks. Will the public be less engaged in solving another major problem at the end of this, or will they have had enough? So these are questions which we all need answers to. They're very difficult to find answers at this stage, but it's very important that we start to ask those questions now and put the work in place so that we can get a better idea of where we stand and what the future is going to look like for us. Thank you.
Thank you very much, Martin. So now Yuri is going to, is a lecturer in the Grantham Institute and is going to tell us about his perspective.
Yeah, good afternoon. Great also from my side to have the opportunity to talk on this topic to all of you. I will be talking about the impact of COVID on the international climate negotiations and COP26, and then also share some reflections on how COVID affects our mitigation efforts and whether the emission reductions that we are seeing now, what do they mean in the grand scheme of things. So first, the UNFCCC, the United Nations Framework Convention on Climate Change, which is of course the area where we normally discussing the international climate change mitigation action. First, what was actually planned this year? There are two big events planned this year. The first was in an intersessional event in Bonn in June, which takes place every year. And that was a very important event because it involves important preparations and discussions of what hasn't been decided yet last year in Madrid. And these topics include, for example, the topics of markets, how emission reductions can be traded between countries, and the topic of transparency. How do we know whether countries are actually doing what they are promising or pledging to do? The second big event in the climate change international climate policy is, of course, the climate summit the COP, the Conference of the Parties, that would take place in November. And this was a really critical conference, and is still a really critical conference, because countries are expected to ratchet up their climate ambitions and come back with new NDCs or national determined contributions. And there you can see already what the event or what the COVID pandemic has resulted in. First of all, the Bonn Intersessional has been postponed to October. And because of that, also the COP, it doesn't make any sense anymore to have it take place in November. So it's now postponed to some point in 2021, and an exact date is still to be determined. So what is the importance of this? Well, this gives countries the time to actually control their national crisis that are playing out everywhere around the globe. But it also provides a bit more time to find common ground on some of the very difficult issues that are to be discussed in normally in June in Bonn. Previous slide still, please. And on markets and transparency. And it also, and the fact that the COP is now until next year, it also provides us with an opportunity to regain momentum for climate policy and potential new climate strategies as part of this recovery. So I think this delay is definitely necessary, and the jury is still out on how this delay will be used for better or for worse. Now, what does this COVID pandemic mean for our climate mitigation efforts? And now next slides, please. As Martin already indicated, the coronavirus could cause one of the largest annual falls in emissions. And here you can see a graph where at the very top, an illustrative range of estimated emission reductions due to the global COVID pandemic is compared to some of historical emissions drops. And you can see there the Second World War, Great Recession, the energy crisis, and so on. Of course, one aspect in this figure is that these are absolute emissions. In percentage terms, drops in the past have been of the same magnitude, if not larger. So the question is really, is this good or bad news? Will this persist? Is this good news for the climate? The figure that Martin shows already shows you immediately that this small drop really is not a solution to climate change. And the question is also how long this will take. And if we then go to the next slide, in our lecture, we have actually seen, and I presented one of these, the easiest way to decompose global emissions. And well, this is even an easier way because it only uses two terms. It uses CO2 intensity and then GDP. And so you can see the annual growth of GDP, which are the yellow bars. Then you can see the change of CO2 intensity per unit of GDP in the green bars. And then the black dots, they provide the overall CO2 emission growth for each year. And in the very last year, you can see that the estimated drop in GDP projections would indeed result in an estimated drop, according to this estimate, which is already a bit older, of around 6% this year. Now, what you can also see from this figure is that we don't want to solve the climate by dropping GDP to zero. That's not how we want to get to carbon neutrality. That's not how we want to get to net zero. So we want that yellow bar to flip back to the other side. And so it really shows that structurally, this COVID pandemic does not provide us with much of a solution. So if we can then, and it can even interfere, the GDP drop down, with the ambition setting of new NDC targets. And if we can then go to the next slide. So in the grand scheme of things, this drop really doesn't make such a big difference. But the key questions is how our behavior and our societal preferences that are really also being shocked now by this lockdown, and also by this awareness of how sensitive our society is to these disruptants, will persist and will change our preferences in the future. For example, will we see more home working? Will we have a preference for less public transport, less flights? We don't like to be for hours enclosed in a space with other people. Maybe also more self-reliance and more local produce. Also, if you can then see in the middle, there more resilient-driven policies rather than just income maximization policy. So the question is still how policy will capitalize this traumatic moment. Will we see it in green recovery or a recovery that will still help incumbents? And so it is important to see that if societal preferences are changing, and Martin already highlighted this, this poll that showed that 48% of the British public is actually in favor of a similar drastic action to limit climate change, then we could maybe see a green recovery. Of course, the question of how much investment is available and where it is put is another one, and other presentations will definitely be speaking to that. So in terms of how this COVID will play out for climate, it is the societal shock provides an opportunity, but the jury is still out whether we will grasp it.
Thank you very much, Yuri. So next we'll hear from Dr. Ralph Martin, who's an associate professor in economics in the business school and who's specialty is to use data to answer interesting questions, as many scientists do. So he's going to tell us about infections of the body and the mind. So Ralph, I'll unmute you.
Sorry, I had to mute. My kid was playing the piano. Good afternoon. Thanks for having me. I want to talk a little bit about some ongoing research that I have started, inspired by the crisis. So it might be an example of how the crisis generates a wave of innovation. But the context is that as COVID spread around the world, and in the bodies of people, there was a similar spread in the minds of some people of something which I have dubbed COVID hoaxism. So various, I mean, it's a whole set of conspiracy theories and accusations, centering around the idea that maybe the whole crisis was made up, or if it was not made up, it was certainly manufactured by the Chinese or by the 5G phone masts and all sorts of stuff like that. That has been happening. Next slide, please.
Sorry.
And I mean, the question is, of course, maybe it's funny, but does this really matter? And I mean, the first question, does it matter for the COVID crisis in itself? And the idea could be, well, if people believe it's a hoax, then they won't, follow all the rules and all the distancing rules, and then it might sort of make the crisis worse. But also what we can see already is that there is a strong overlap between COVID hoaxists and climate hoaxists. That's the same people that sort of think climate change is a hoax, that also think that COVID is a hoax, or at least there's a big overlap. So by understanding this kind of hoaxism, maybe we can learn something about climate hoaxism. And in the next step, the question is, okay, this is a massive event. And while I share the sort of questions and the hopes that previous speakers have mentioned, that maybe it changes how we behave, maybe we want to stick now at home more, travel less, and these kind of things. I think one key thing is maybe it changes our general attitude towards, say, scientific advice, and sort of that will maybe make a difference or make not a difference when it comes to voting for the right parties and supporting things like drastic action on climate change. So to understand all of this better, what I started a couple of weeks ago is that I started sampling tweets related to COVID and related to climate change as well. And what I want to talk about briefly, because I don't have much time and the research is still ongoing, so that all comes with a disclaimer, I just want to talk about a couple of things which I already have seen. So as of today, I think we have about 12 million tweets. And what you can see is that you have, using a conservative estimate of what is so there's a big difference, of course, between tweets where somebody talks about hoaxes and tweets that are by hoaxists expressing support for hoaxism. But if you have a conservative estimate, so somewhere between 0.5% and 6% of all COVID-related tweets are hoaxist tweets, and that's sort of. But I already in this period I saw sort of certain waves of where there was sort of a massive outbreak of hoaxism, and then it died down again a bit, and it started again a bit. So you see a timeline down there. Next slide, please. But of course, the first big question is, well, fine, fair enough. Does this make a difference? So I started looking at that by looking at the US and the US states, simply because a lot of people tweet there, and also there are other things more homogeneous within the US rather than if you look cross country. And something very interesting seems to be emerging. So we have all heard about New York, and everybody knows that in New York, the sort of infection rate I should say this is New York State, right? This is not New York City or Manhattan only. The infection rate is dramatic, much more than in the rest of the US. And many people have sort of, linked this, well, New York is very dense, and it's true, New York is sort of a denser place, but if you look on the right-hand side of this figure, you see that also New Jersey is very dense, and Massachusetts is very dense, Rhode Island. And New York, in a way, is more of an outlier when you just look in the density. But what is very clear in New York, surprisingly, is also the record state when it comes to hoaxism in the US. And what seems to be emerging here, doing some more background research, is that it's maybe the and we should also say, if you look down there, but then we have other states like Alaska or North Dakota, where you have fairly high rates of hoaxism, so the share of tweets that are hoaxes, but not so many COVID cases. So what emerges from this, or what this suggests, is a kind of a hypothesis that maybe hoaxes tweets are particularly bad when you are in a dense area, more dense area. So this is something which seems quite robust, and sort of early calculations of mine suggest that if it weren't for this hoaxism, then the deaths in the US might be around, this is not the deaths, the cases at this point might be much lower. Maybe 20% of all cases are down to hoaxism. And well, this is certainly big enough to explore this further. Next slide, please. So then the next thing is then, okay, what does this all mean for climate change? And this is what I alluded to earlier. So what you see here, you see the share of tweets about climate change. The red line is for COVID hoaxists, and the blue line is for non-COVID hoaxists. So it's clear that COVID hoaxists are much more obsessed about climate change than COVID non-hoaxists. But of course, recently this has been declining. So they had something else to tweet about, primarily the COVID crisis. So both groups tweeted less about climate change. But then what is interesting is to see, okay, fine, they tweeted less about climate change, but to what extent was their tweeting about climate change about the hoaxism of climate change? Yeah, so when they're talking about that climate change is still a hoax, and that would be the next slide. So that's what we see here. So basically we see that, the non-COVID hoaxes, they're hardly, if they put out a climate change tweet, it will be hardly a tweet that says that climate change is a hoax. So this is the blue line at the bottom. Whereas you see that the people who are COVID hoaxists, if they put out a tweet about climate change, it has quite a high likelihood. And again, this is a conservative measure of what is a hoax tweet. Around 7 to 10%, they would say it's a hoax. And this has been going back in time. Now, what we were asking here, what we were wondering is, now what kind of difference did the emerging crisis make to this, or if at all? And what seems to be happening, if you look at the red line up there, so initially when the crisis started primarily in China in January and February, you had an increase in the share of hoaxist climate tweets in this group. And one hypothesis we're exploring is that maybe the initial response here was a kind of a polarization. So these are the people who have previously been convinced about climate hoaxism. Now there's this other crisis emerging, and reinforces their a belief in their previous hoax. But it seems to be, and this is tentatively maybe a positive development, that in the later period, and come April, where the cases in the US went up, and people maybe experienced, these people are really sick, my neighbor is really sick, I'm really sick, that this is maybe something serious, and maybe what we see there is the onset of a reversal in beliefs by these previous climate skeptics. So that is basically where we are now. It's early days, but I think there are some interesting trends in this, and there's more we can do. I mean, this is also a data resource we're building up now, that we have all these tweets and all this information, and I think there are many questions we can analyze with this, including more things related more to the economy, about what is happening, what is the economic impact of this, and how does it affect firms as well. These are things we're going to explore in the future. Thanks very much.
Thank you very much, Ralph. Exciting research, and we look forward to seeing more. So now let me introduce Charlie Donovan, who heads the Center for Climate Finance and Investment, and who will be giving us his perspective.
Great, thanks very much, Maribel. Can you hear me all right?
Yes, very well, thank you.
Great, perfect. So I want to take just a few minutes to talk about some of the developments that have been happening over the past few weeks that don't relate, let's say, directly to climate, but do relate to the world of energy commodities, and which is a huge determinant of how things are going to play out. So I want to maybe sidestep a little bit the question directly and come at it from a slightly different angle, but hopefully you'll see how I'm connecting the dots. So if you'd mind to advance the slide. So we know really well that there's this mismatch in the world. There's a mismatch between who uses fossil fuels and who's going to be hurt by the consumption of fossil fuels. This is a slide that came out of a report that we did for the UN a couple of years back. And for me, it really is a stark reminder that what's to play here is a real inequality that a lot of that result from who uses and who benefits from fossil consumption, and there's a real mismatch between the two. Could you go to the next slide? The other thing as context to say is that the fossil fuel also, even in developed countries such as the UK, the US, Europe, there is still a cost that we bear from fossil fuel use, which has actually nothing to do with climate and has everything to do with the volatility of its price. So if you look at this chart, which is describing how the volatility of stock markets and the volatility of the oil market, you don't have to run too many regressions there to see there's a pretty good map. What happened a few weeks ago, as many people who are watching this will know, is that in the midst of a huge demand shock associated with closing up our economies, OPEC simultaneously delivered a supply shock, which was to continue to produce and actually produce at higher levels, even though the most basic view of economics would tell you to curtail. And that really was, I think, a stark moment at which we realized that there is another overlapping crisis ongoing here, which is the fragility and vulnerability of our economies to an over-reliance on fossil fuels. And so as we go through the next months and years, really part of this recovery is going to need to be understanding that relationship, understanding that source of vulnerability, and ultimately seeing what we can do about it. And if you go to the next slide, we start to begin to see, what can we do about it? So this is it's called a Sankey diagram. It relates to U.S. energy consumption. One of the national labs in the U.S. does it every year, and I think it's a really, really informative one image snapshot of where do we get energy. Where does it go, and ultimately how is it used or wasted? And so what you can see is, despite the fact that we talk a lot about wind and solar and really excited about renewables, in terms of primary energy, there's still very, very small components of the US energy system and small components of the energy system of most major economies. So even though renewables is really having a day in terms of penetrating into the power sector itself only constitutes a small percentage of overall energy use. And it's really about thinking about how do renewables, or renewables that then convert into synthetic fuels like synthetic methane, ammonia, even in hydrogen, how are these things going to happen? And we have for a very long time thought about that as purely an environmental task, and unfortunately assumed that at some point, knowing that fossil fuels have to run out someday, we would be assisted in this process by an overall increase in oil prices, in natural gas prices, and coal prices. And the last time we went into a financial crisis, that was very much the case. So in 2007, a huge run-up in commodity prices across the board, but in oil in particular, at what point where it peaked at $147 a barrel. When the financial crisis happened, obviously that went into a strong reverse and landed somewhere below $30 a barrel, and then stabilized and has been on a path ever since. So we're really in a very much an unprecedented situation now of going into this crisis where actually the falling oil price is part of it and not a consequence of it. And it really is going to compound the challenge that we have before us, which is if fossil fuel prices are not increasing and we have a real prospect of them being lower for longer, then what does that mean for the introduction of technologies and the scale up of technologies that ultimately have some amount of price competitiveness that depends upon them? So for biofuels, that's clearly the oil price. For renewables like solar and wind, that's much more about the natural gas price. But it's about dissecting the energy sector itself and understanding where do we want to go next in terms of moving out of just power generation and into things like heat, into things like industrial fuels, and how quickly can we begin to do that? And the great opportunity, of course, is that renewables have never been cheaper. There probably will be a huge amount of pressure on solar in particular over the next 6 to 12 months, which could make them cheaper again, as there's an oversupply of panels. So this is very much an interesting time. If you go forward to the next slide. I just kind of want to conclude by saying, what the other overlapping issue to look at for those of us that are concerned about the pace of the energy transition is what's happening in the stock market. Of course, in the first opening days of this, there was a huge drop in stock markets around the world that has surprisingly to many people, including myself, stabilized, and they are not back at their historic highs, but they are not as far off as you would expect for a global economy in which half the world's population is sheltering inside. And so the question going forward is what level of bailout and recovery is needed for company particular sectors. So in the oil industry, in the airline industry, in those very highly carbon intensive sectors, is the public going to support a round of fiscal support when the stock markets are communicating that there's really not much of a problem at all? And if you just go to the last slide, please. And one kind of closing note is thinking about how energy and the dynamics of how the capital markets interact with the energy sector, because we are at a point at which we are going to need huge volumes of capital to come into the energy sector. If there's one kind of unintended consequence of the great work that's been done to raise the profile of the risks associated with climate change, one unanticipated consequence or unintentional consequence is that may be leading to people wanting to reduce their exposure to energy entirely. And so you can see this graph, which shows that in the S&P 500, the US stock index, the energy sector has never been such a small component of what makes up the S&P 500. So previously you've had companies like Exxon dominating the top 10 of the S&P. Now they're following quickly down the list as tech companies, as more new economy companies take their place. And that's a concerning trend because while we would like to see a lot of rotation within the energy sector, a total decline in the volume of capital that's going into the sector full stop is absolutely a negative trend that will have to be corrected. So I'll stop there just to say that there's a lot to this crisis that intersects with energy markets, intersects with stock markets, and ultimately raises questions about what will be the future trajectory of the energy transition. And hopefully we can get to maybe some more of that in the Q&A.
Thank you very much, Charlie. So actually that's a good point for the students who are listening or other people listening, that you can type in your questions in the Q&A box. So our next speaker is Dr. Josue Tanaka, who's Managing Director at the European Bank for Reconstruction and Development, and is also a lecturer on the MSc CCMF, who will be teaching the students next month for the module on climate finance. So thank you very much for joining us today, Josue. Josue is going to tell us about the role of development banks in the months to come.
Thank you very much, Mirabel. So I hope that my internet connection will be stable enough. If it isn't, I will disappear from the screen, but hopefully the voice will continue. I also apologize that I don't have nice slides to show because unfortunately, for reasons you will understand, I didn't really have the time. So first of all, thank you for the opportunity, and thank you, Martin, Yuri, Ralph, and Charlie for the previous presentations, because I think we can see the variety of insights and questions that you raise. So what I'll try to do in as structured and short a way as possible is to complement what you said with perhaps some partial answers, particularly from the financial perspective, and more specifically, as Mirabel mentioned, in terms of what can development banks do to contribute to the building or the building of a greener economy. So first of all, I think it's important to perhaps look at three phases here, because if we look forward, we are probably right now still in what I would call a survival phase. In other words, we are dealing with the questions that we see every day now: PPE equipment, what's happening in care houses, care homes, and therefore, this is obviously dominating completely, the agenda. We will probably then move at some point, and you see this already, maybe the beginnings of this in countries like China, for example, which I would call as the recovery phase, where people, emerge, from the survival mode, look at the damage that's been done, and then see a bit, how to move from there. And the third phase is really the one that I will focus on, is really what I would call the stimulus phase, or the phase, in which, you will, all countries will probably have to invest, a lot in terms of getting back, to some form of economic growth. So clearly the challenge that we have ahead is the usual, first, the alphabet question. Will we be confronting a V? Will we be confronting a U-shaped recovery? And hopefully we're not going to be confronted with a L-shaped recovery, which would be a very dark, outcome. And therefore, I would say the key question that we have for ourselves is really on the upper moving sides of the V or the U, what can we do to what I would say green the stimulus? And I think here it's very important to mention one point, which is timing. Because if we do believe, the science, if we do believe the IPCC 1.5 degree report, we essentially, have about a decade to shift things. A decade, again, I think it was Martin who mentioned the point about the curves, so, okay, we have the COVID curve, but we also have the emissions curve. And therefore, if we have 1 decade, if we miss this particular opportunity to connect, then I'm afraid, that we go off the path. There is no way, that one can, catch that up later on. Both because the size of the investments that are going to be made are unlikely to come back, within a decade, at least we hope. And because, if we don't, if we're unable to connect, then again, we'll run out of time. So we cannot miss this turn, if I could put it that way. So what can we do? In terms of the development banks, I think a first point is to mention that to a large extent, they have been created to play a counter-cyclical role. And therefore, in this situation, of crisis that we have and of depression to a large extent, the question is, what can, in terms of investment, what can we do to invest, at the bottom of the curve? The second thing is also to mention another dimension here, which is the difference between the developed world and the developing countries. We actually don't know yet what the impact of COVID-19 is actually going to be in developing countries, right? And what is going to happen in particular to countries like India, for example, which are absolutely key in terms of the future of what's going to happen in emissions. In terms of finance, it's interesting to note, for example, that in the last crisis, 2008, for EBRD, for example, that resulted in a doubling of our investment volume, and that is where we are continuing to operate today. Also, as background, to mention that in the last few years, we've had a big increase of the share of our finance that has gone into green finance and climate in particular. Okay, so if you look, for example, between 2016 and 2019, our climate finance has increased by over 50% in that period. So you have a double effect of things that have happened, at least in the period to today, which is both an increase in investment due to crisis recovery investment, and number two, an increase in the green share of it, reflecting, the emphasis on, environment and climate. Collectively, the MDBs accounted for about $48 billion of investment in 2018, and they played, I would say, the biggest role in terms of the contribution to the famous 100 billion target that was set in Copenhagen. So I think, back to the beginning when I said, the different phases, at this stage, I have to say that, part of my day is occupied in two opposite timeframes. One is, in a way, dealing with the short-term impacts of what's happening, because our clients, for example, are confronting difficult financial situations. And the other side is we are spending a lot of time thinking about, how can we embed the green element into future recovery plans. And that's what I'll try then in the final minutes here to give you a bit of feel as to how we're doing this. So first of all, it's also important to mention that development banks don't only work on money side, but they also work on two other elements that are important. One is policy, so working with our countries on policies that relate, to the energy sector, to the transport sector, to climate. The other element also is capacity building, right? That we do work a lot on building institutions and local capacity to deal with these issues. Because often people just look, at the money side, and quite frankly, unless we're able to be effective on the policy, we will never be able to have enough of an impact to actually make a big difference. So at this stage, and this gets a bit, connected to the points that Yuri mentioned, we are continuing to work on the COP26 front, even though there is the uncertainty on the date. We are continuing where we can to work on policy aspects with our countries on elements such as providing support to their NDC formulation. We continue to work on sector policy change, for example, in the energy sector, work at the city level, and particularly there, what is the impact of the current crisis on their priorities, and work with our individual, for example, industrial clients to try to see to which extent, the measures that we've been discussing previous to the crisis can be continued or whether they should modify. So to conclude, I would say the key question that we're working on right now is really where can we identify the areas of convergence between a green recovery and the economic stimulus packages that will come, with a particular attention, where possible, to activities which are going to be labor intensive, that are in relative terms lower capital intensity, and that are also ready to be deployed quickly. And so examples of this for now, certainly energy efficiency in buildings, which is something that's not been moving fast enough, but does provide a lot of opportunities in this area. Trying to keep the dynamics, and this links a bit to the points made by Charlie, on how can we maintain the momentum on renewable energy development, where momentum has been acquired? What can we do to accelerate elements, for example, of circular economy in industry that deals a bit with the implications of the COVID-19 on issues related to complexity of supply chains, for example, and what can we do in areas, for example, like sustainable food and the reduction of waste. So these are just examples, if you want, of the type of areas that we're now thinking on putting together so that we can have that intersection between the economic recovery packages and impact, if you want, on the environment and climate front. By coincidence, we are actually, EBRD, working on our new climate strategy to 2025. So in fact, I would say the timing of our strategy is actually good to try to embed at this early stage, so it's not easy to do, but to try to embed at this early stage what can be the implications of the current situation on the formulation of our strategy. So I think I'll close here, maybe just a few points that maybe the way I'm presenting make it sound easy, but there are a lot of questions and lots of uncertainties here. What's the impact on public finance? What's the impact on the financial condition of utilities with whom we work? Financial markets, I mean, maybe a question to Charlie here that, there's been a lot of nice movement over the last couple of years, with TCFD, with lots of these initiatives. Will this be also affected, by the current situation? And so I think my final comment would be here to say that I think one of the things we need to do in order, and it will be interesting to see how we can do that, is really we need to end this notion that the climate challenge is a long-term challenge, right? Because what derailed everything in the run-up to Copenhagen, for example, was we had a crisis, everybody became obsessed with the short term, people said climate is for the future, and we saw what happened. In this case, I go back to my initial comment about the time frame of the 1.5 degree report. If we are to take that seriously, which I think all of us do, then it has become now a short-term problem, and therefore should support the convergence between the green dimension of an economic recovery package. That's it. Thank you very much.
Thank you very much, Josue, for these insights of how we need to think about the not so distant and short-term future. We'll now hear from James Roby, who's a global head of corporate sustainability at Capgemini. And the questions that the students put for James is, how will COVID-19 change the way businesses react to or prepare for risks? So thank you, James.
Thanks, Mirabel. So taking the lessons from this current COVID crisis, and how can that improve business resilience to climate change? So I just wanted to reflect on three topics. So first of all, is this a wake-up call? And are businesses going to wake up to climate change more because of the current situation? I then wanted to spend a minute or two thinking about the way that businesses manage risk in general and manage climate change related risk. And then maybe reflect a little bit on what happens next, which I guess is open to much debate, but let's see where we can get to. So I guess first of all, is this a wake-up call? What's been quite interesting over the last few weeks is seeing the implications of the crisis for different industries. Some industries are more impacted and less impacted. Some industries have seen a massive spike in revenue. So listening to the head of Unilever or listening to some of the supermarket heads talking about their businesses, from a revenue perspective, they can't sell enough goods or make enough goods and get them through the supply chain quickly enough. So some industries are more or less impacted, and we're certainly seeing that through some of the industries that we work with. And then some industries are more or less able to respond to or to adapt to the requirements of the new world. So we as a business, we're about 270,000 people spread across 50 countries, working in the professional services industry. And the big challenge that we've had is, how do you get 270,000 people working from home within about 2 weeks? Now, that's been a big challenge for us, but it is a challenge that is achievable because most of our people are equipped with the technology to do that. That's not true in a lot of industries, either from a sort of physical operations perspective, or simply they could move to a remote delivery model had they got the technology, but the technology wasn't necessarily in place. So I think, is it going to be a wake-up call? Well, quite possibly it's going to be a wake-up call for businesses who've suddenly had to react very quickly and had to try and go through a remodeling of the way they work in 2 weeks. Interestingly, I was reflecting with somebody a few weeks ago, and travel is perhaps the biggest challenge from a climate change perspective from the professional services sector. And I was reflecting that COVID had done in 4 weeks what climate change had failed to do in 10 years in terms of persuading certainly our industry to stop traveling quite as much as they had historically. It's interesting, if you look back, you can think of previous shocks. I was just checking the dates, and ironically, 10 years ago today, the skies above Europe were as quiet, if not quieter, than they are today, because we were in the middle of the eruption of the Iceland volcano, which gave us a 2 to 3 week disruption in flying. Interestingly, you could say what happened after there, and the response to that in terms of people taking up new technology as an alternative to flying. I suspect two things happened in that case. First of all, the disruption was only fairly short term, 2 to 3 weeks. And secondly, the technology probably wasn't quite as all pervasive as it is today. So that was one shock I was thinking about. Another shock I was thinking about was the fuel crises, which were about 20 years ago, which was when the petrol tankers went on strike. Everybody thought they couldn't get petrol and immediately flocked to fill up their cars with fuel, and all the petrol stations ran out of fuel. And we had a couple of weeks of disruption with the supply chain struggling to respond. And I guess we've seen that with the supermarkets this time as well. So I think that's the first sort of reflection. Is it a wake-up call? I suspect it will be a wake-up call for many, and many will be starting to think about how they make their businesses more resilient. Secondly, I was going to reflect on climate change risk and how organizations tend to manage that. And if you take a standard risk management process, you go from looking at your risk drivers and the implication that has in terms of risk events, the implications that has to your business, and then what mitigation strategies you put in place. And it's quite interesting because when we look at it from a business, when you get down to the implications are similar. You can think of, often you can think of multiple risks which lead to the same outcomes. So we have you could take climate change, and you could take extreme weather events which could disrupt your business in the sense that your workforce can't get into work, which is rather similar to the situation we have at the moment, in the sense that people who would normally travel into offices can't get into offices. So again, I think what we might well see is that some of the similarities get people to start making their businesses more resilient, which will have the knock-on effect that they will be more resilient to climate change. Josie was talking about just now TCFD, and certainly a lot more businesses are going through through a much more rigorous process now, thinking about both the transition risks and the physical risks associated with climate change. And there's some, I won't dive into the detail, but I suspect that there'll be a lot of businesses trying to figure out now what does, sorry, let me rephrase that. There'll be a lot of businesses now looking at their risk processes and realizing that there's some similarities in terms of the risk drivers and the risk events that climate change could deliver. PwC did quite an interesting report on climate change risk, and they concluded that one of the UK supermarkets found that 95% of its supply chain was vulnerable to climate change. So that's sort of just sort of thinking a little bit about climate change risk and how it works. And then the final thing is, well, thinking about what happens next. And again, we were just talking about now from a economic perspective, you know, does this hit the economy as a V shape, a U shape, or an L shape in terms of the recovery? And we're tending to think at the moment about what that means from an economic or a GDP perspective. I guess the challenge will also be thinking about that through the lens of carbon and whether we see a V-shaped response in terms of carbon, a U-shaped response, or an L-shaped response. I think from our industry, and certainly from my perspective leading sustainability for a big professional services business, the challenge is going to be, how do we get people to not immediately start traveling again and going back to the new normal, and almost rephrasing the question, which says, well, actually, we're now delivering in a near zero travel mode. How can you, in the future, compare travel compared to the current baseline, where we're actually proving that you can deliver quite effectively in a lockdown remote, way of operating? And interestingly, it's, I think, challenged the whole professional services industry to really challenge a dominant logic, which is it is possible to deliver remotely. It is possible to deliver without the huge levels of travel. One of the groups that I work with, which is a group of UK professional services industries, I think we calculated that between us we were expending 1 million+ hotel nights a year, so 1 million nights away from home for people in the industry. So again, that's sort of a thought in terms of the rebound. And then one final thought to throw in to close things off. I think what will be quite interesting from a reputation perspective is the perception of how organizations have behaved. So clearly, as I started at the beginning, I said there have been a number of industries which have had a massive revenue kick. The CEO of Unilever was talking a couple of weeks ago about how his orders going through, his weekly order book was now looking more like his monthly order book had been 2 months previous. The supermarkets have clearly also seen massive spikes in revenues. I guess there'll be a real challenge for some of those household names when their quarterly results come out. And I think nobody's going to be surprised when their revenues go up. But if they're perceived to have a massive spike in profits associated with those revenues, I suspect a few people might be asking questions about whether they've been profiteering. So I think there'll be some interesting challenges and some interesting reputational perspectives which come out over the next couple of months.
Thank you very much, James, for these thoughts, and very interesting to have the view of what's happening in the professional services sector, which is so important for thinking of the future and dealing with the crisis now. So our last speaker is Richard Templer. He's a professor in chemistry at Imperial College, and he is going to be teaching next term the students a module on clean tech innovation. And so Richard, the students were asking what your sense is of what the impact of COVID and the economic crisis will be for the clean tech startup and innovation sector.
Right, thank you, Maribel. Can you hear me okay?
Yes, we can hear you very well.
Good, excellent. Well, I'm the last person to talk, and there should be a time for answering questions as well. And actually, it was funny when you put up the first slide and it showed this long list of people giving talks, all very august and so on. I noticed it looked a little bit like a creature with a very long digestive tract, and with me right at the back end of everything. And so maybe I should give a warning that being at the very back end of a big digestive tract does mean something about what the output from that end is like. It won't look very pretty, and it might be quite hard to interpret, and you might want to hold your noses. So let's get started. I'm going to talk about what I can tell you in 3 parts. The first is about immediate impacts, things that I already know are going on. The next one is actually, in some ways, the harder one to talk about, and that's the medium-term impacts. And then the longer term impacts and what I think might end up happening. And this is, of course, all from the perspective of startups who are in our area, in the area of climate change innovation. So the immediate impacts, both that I've noticed, but also that I was very lucky today, Startup Genome produced a set of data which is about the startup community more generally, but it seems to parallel pretty much what I know about that's going on in the community. So the first impact has been cash flow. So globally, about 42% of startups have only got 3 months of liquidity. So clean tech startups that I know about are sort of been battening down the hatches, trying to breathe as little as possible, use up as little as possible of their money in order to survive as long as possible. In fact, rather interestingly, rather perversely, it's harder for those startups that have got seed investment, the ones that have already got money and are therefore employing people to do stuff. Because in almost all cases with clean technologies, they aren't digital technologies, mostly they're engineering or agricultural technologies, things like that. So you actually need people together in a room doing stuff. And of course, that's what you can't do at the moment. So they're quite hampered because they're still paying out salaries unless they put people on furlough or whatever. And in fact, that's the next point. The next point is that there has been a cessation of activity, and worldwide, Startup Genome says that 58% of startups have had to terminate contracts already. So people are already trimming back just in order to survive. So those are the sort of, those are all negative things. There's things which are very particular to the UK about government offers of backup and so on, seem to be quite hard for startups to access because they're young and the various rules that abound around the place. So it's not a very happy time for startups, and especially those who've already got their first injection of cash. The ones that don't have an injection of cash, actually, they aren't employing people. They're managing apparently to just kind of go into a state of hibernation. The other thing that we've been trying to encourage startups to do, and the best of them are doing anyway, is to use this time as a time for a pause for thought and reflection on their businesses and exactly what it is that they're doing and why they're doing it the way that they're doing it. Because most of their normal days, 5 weeks ago, were spent just running in order to do stuff, and now they can't do that anymore. So they should spend more time thinking about their business models, thinking about their future prospects and so on. Anyway, that's the immediate impacts, which are not all that positive. The medium term impacts are the ones that I find the hardest to talk about. So I've got very little in here really. And they're all sort of question marks. So the first of those is especially pertinent to governmental sources of funding for startups in our area. And that is resource being redirected to COVID-19 at such a volume that it's going to impact what looked in the budget to be quite an injection for their activity, because obviously that we don't know really where the money is coming from. The only thing I do know is from a very small set of conversations is that government does seem to be mindful of their commitments to a green economy and is thinking about how it's going to restart our economy, and that they will have to think about the opportunity, if you like, about this dreadful event, an opportunity for boosting up more of the green economy as they feed resource in once we get back to some form of normality. anyway, waits to be seen. I really, it's just more of a question than an answer. The next is also more of a question and an answer, and it deals with the private sector and LPs. Do they have less disposable resources? Well, it does seem so. A lot of family offices, for example, have money. Well, ultra high net worths have got money that they've invested in the markets, and they've invested them in places that have lost a lot of money. So they will have fewer resources. How that will affect their attitude is another matter, because they are still incredibly rich. They still do appear to be very committed to doing things about climate change. So maybe I'll give you one set of data that I know about, which is that there's about $3 to $4 trillion worth of money in the hands of family offices around the globe, where the younger generation is taking over, and they're putting a lot of pressure on their parents, their elders, to hand over the keys to the safety deposit box, and they're talking to the private banks about how they can deploy this money to do good, and to do good in particular about climate change. I would hope that they would see COVID-19 as a strong message about what happens if you don't act on science. Anyway, then the last thing that would be a medium-term impact, which I do worry about, is what does normality really mean? When we've been thinking about this in the university, it doesn't mean we can just go back to having everybody in lecture theatres and the laboratories doing what they did. We recognise that this may take a long time, and that we will be working to different patterns. For the startup, that return to some form of new normality may have an impact for them in terms of their cash flow. In other words, if their cash is being burnt at a rate which is as fast as it was before, but they can only work at a slower rate because they can't get into incubators and work together for longer than X number of hours per week, that will have an impact on them. So I'm really quite concerned about that. All right, enough of the gloom and doom. Let's talk about the longer term impacts. I feel actually rather buoyed by the fact that people have had to listen to the science, and it's evident what happens when you don't listen to the science. So the science was already out there for COVID. Governments did not listen. They preferred to not spend money up front to be ready. And as a consequence, they've all been caught with their trousers around their ankles, and that's an embarrassing position to be in. And there will be, in my estimation, quite a lot of fallout for governments who did not act in a timely manner, who did not listen to the science. And that, I believe, will have positive echoes from the point of view of the science of climate change. And that should be good for startups in this area. In other words, they can use the science of climate change as part of their pitch. I also see evidence, not just nationally, but locally, that people in government are thinking about regrowing the economy, rebuilding it, and recognizing that this is an opportunity to do it green. And it'll be very interesting to see what happens for those businesses that will be pleading for money, but are not part of the green economy. Time will tell. That does suggest as well that it might be good for clean tech startups, because they will be part of the new economy, and the best of them may find government being more receptive to their point of view. I'm going to, because we really are running out of blooming time, I'm going to finish off with two things. The first is something that nobody's really said, but I'm going to say. I think there is not a uniform, not a universal, but a growing recognition that markets on their own and the sort of the market-driven philosophies of the 1980s are inadequate in the face of major natural challenges. In other words, government intervention is needed. The government, our government, that is, full of acolytes to Margaret Thatcher and her creed, have had to go in. They look more like FDR and the New Deal than they look like Margaret Thatcher and Friedman. So I think nature always trumps politics and economics. It's not an externality, it's a reality. And that is a hard lesson to learn and a painful lesson for many. Climate change is a lot bigger problem than COVID. It's going to require a lot more energy and a lot more intervention. So I'm hopeful that government will take that message on board, and those of us in the field will pressure them more to recognize that. The last thing I'm going to say is about financial inequality and where the impacts of these major natural challenges lie. It's very visible at the moment that our economy, the basics of our life, rely on people who are not paid very much, who do not have the resources to isolate themselves from the virus. And without them, we would not be able to survive. And yet, they get paid less, they get impacted more. The same story is true for climate change as well. So I think the other thing that I would like my startups to really be thinking about is your new business. How does it create jobs that create interesting jobs for everybody, not just for the smart guys like you in the audience, but also for the people who are going to be doing manual jobs, who are going to be doing things which are really important for our fate, but which are not very sexy, not at the moment very well paid. We can't continue to have this inequality. So the new economy that I hope these startups will be part of, I hope will both recognize the inadequacies of purely market-driven economies and also the huge problems of financial inequality and the way they impact people in the face of natural challenges. Thanks.
Thank you very much, Richard. So I think lots of food for thought. And we have about 5-10 minutes left. So I think I'm going to, I can see up here on my screen that we have a few questions from the audience. So I don't know if I can actually get the students to ask them themselves, but it might be difficult. I'll just read them out. So the question is for Yuri, but we can, if others want to intervene, they're happy. So we in the lesson, the lectures that the students had, they heard about different extreme events. And so how do you think that COVID would fit into these types of categories, and how does it relate to other extreme events, and therefore what we can learn from in our modeling and in our understanding of how to deal with extreme events in the future?
Yeah, well, thanks for that question. I'll answer quickly. First of all, we hope that COVID is a transient event, a very big shock to something that we kind of not necessarily were expecting, but it's not out of the realm of the impossible. I mean, and what we see and what we want to understand from transient event is how well can our society cope in that particular disturbance, and that's, so how do we cope with the lockdown? How do we cope with the forced distancing or with travel restrictions and so on? So that is definitely a transient event. But then what this transient event can lead to is indeed that the drivers of our society are impacted, and that we start to see disruptive drivers. And there it's really the shift in preferences. And this kind of links to what many others have said. Are we going to see a shift from kind of populistic grandstanding by policymakers to science-based approach and fact-based and evidence-based approach to designing policy and choosing the path for our society? Do we put in fairness and inequality at a higher rank or in our preferences? And then also what I mentioned earlier was, do we value resilience above just maximizing the return on our investment? And these are really disruptive drivers, and altogether they will then still need to show whether this is a totally unexpected outcome that will be totally outside of the envelope of what we could have imagined until now. But that is only something that we will be able to answer a couple of years from now. Fortunately, this crisis now has opened a bit our eyes to the possibility of governments investing huge sums. I mean, we have here in the UK, we have a right-wing conservative government that is putting enormous amounts of money in the economy or in back to society, and that's just unseen before. How are models going to include this? Well, most of this can only be covered by new scenarios and so on, and a lot of research is going on now. I mean, I can tell you from the community I am in, it's not a day passes or I receive an email of someone who has a great idea of how to do a few scenarios and how to make sure and understand this, and see what the implications are for the future. So yes, it will be taken into account. The big question is the next crisis or the next shock that comes unexpectedly, will be prepared for that, and will we have seen it coming? And I think that I haven't seen the evidence yet that we have changed our thinking.
Thank you, Yuri. So there are many really interesting questions, and I don't think we're going to be able to go through all of them, but I thought maybe having a slightly a bit more from Charlie on financial markets. If Charlie, are you still there? Because I can't see your picture, but
yeah,
yes.
Yeah, I'm here.
So there's a question here on how ESG funds recently were outperforming the S&P, and how can we think that these reallocations might return to status quo afterwards, in particular once the stimulus funds we were just talking about might be allocated to non-sustainable equities?
So that's a big set of questions. Maybe I'll just offer a couple things there, which is one, you know, it's a big question why ESG funds have held up. You probably, students have seen MSc has been putting out a lot of work over the last couple of weeks saying that there's been defensive property around ESG. I have to say our own research, I'm not sure would confirm that. I think ESG is a very, very difficult concept to operationalize in capital markets research. And so it's a lot about who's doing the cutting and dicing about what's ESG and what's not. And I think there's a lot of potential cherry picking that can go on in order to make things look good. And it looks a lot more like a marketing exercise than it does a proper piece of work. But I will say there is a real question now, and there's some work that we've been doing with the International Energy Agency on looking at clean tech in particular. There was a huge run-up in share prices in clean tech companies in 2019, a little bit of 2018, and we have seen that even despite the oil price fall, those companies have held up a lot better than fossil fuel companies. So we're starting to see some things for the first time, which is that, you know, the market is starting to unpick the relationship between, let's say, a solar power company, which actually has very little to do with the oil price, and maybe starting to get some of these relationships right. So I'm curious, as I'm sure the person asked the question is, what would that be? But I have to say that it's one should treat it with a bit of caution, where something kind of as broad as ESG is held up as performing better or having any kind of defensive properties.
Thank you very much, Charlie. So a question maybe for James or Richard. Maybe let's start with James. Is the students who are listening are obviously worried about their job prospects ending this master's, and I think rightly so when we're facing such an economic crisis. But so the corporate climate action, James, recently was flourishing when the companies had a lot of money to spend. So how do you think the sustainability job market will be impacted in comparison to other jobs? And should students be thinking about different careers or working more in policy, or with startups?
So great question. I can't answer it directly, but I would like to hope that the focus around sustainability from a job market perspective continues. The way I would answer it would be, about 4 weeks ago when the lockdown happened, I was reflecting on, well, what does that mean for my team? So I've got a team of people here in the UK and around the group working on sustainability, both in terms of how we become more sustainable as a business, but also how can we help, how do we go about helping our clients become more sustainable? And that first Friday evening of the lockdown, I thought, well, everything's going to go quiet now. Nobody's going to be interested in sustainability. And I've been quite encouraged and maybe amazed as well a little bit over the last 4 weeks. I have had more conversations with client execs around the group. I've had more conversations with clients who are still very much focused on the fact that we need to find, we need to focus on sustainability going forward. So I don't know what it's going to do in the short term in terms of the recruitment market for graduates, but I'm quite encouraged that certainly from the people I've been talking to in our business and also other people I know in industry as well, that this isn't going to push sustainability off the agenda as far as we can tell. And I'm mildly optimistic that actually more companies are going to see that sustainability needs to be part of the rebound. So that's perhaps a very thin data point, but that's the data point that I've had over the last few weeks.
I can double the thin data point simply by saying that I've had exactly the same experience. In fact, I was answering, was it Jonas? Yeah, Jonas Fuchs. I was typing an answer, but I might as well say that now because it's along the same lines. And that is that I've been talking to some big corporates, and I would say that COVID for them has been an inducement to firm up their opinions of what they need to do to transit to a new economy and to be more sustainable and so on. And in fact, one of them said, I'm having to deal with all this horrible stuff. This is the defaulting companies around who were not paying bills. And he said, the thing that keeps me going is that I have to deal with this today, but I know that tomorrow I'm going to have to do this other stuff. And that's the stuff that I think really matters. There's also something which we haven't said, and there's another question here that kind of relates to. There is a difference between COVID and climate change. COVID, we knew it would happen, but we weren't quite sure when it would happen. So it exploded. It was very rapid and it exploded, right? And that has its own difficulties to respond to as a government. Timing is very difficult. Climate change has been, our predictions about climate change have been much better than any economist's predictions about the economy, or indeed any other predictions that I can think of a complex system. So we really know where things are going. We've had plenty of time to react. this kind of kick in the backside says, look, there's reliable science here. We know what we need to do. Just get on and do it. So I get the impression that corporates feel a sense of purpose and that it's something that they can engage with because it's more solid, it's more kind of tractable in a way than COVID is. So James, I'm a bit more positive than you are, but my experiences have been the same. I'm really quite hopeful that people are going to really get to grips with this.
Thank you both for your answers. So unfortunately, our time is up, but thank you for this great conversation. I think it's sparked a lot of reflection on, what change in behavior this crisis is bringing. Will it change the opinions and the reliance on and listening to science? Lots of us are scientists, so we hope it will. And then it also, I think, brings forward the questions of what will the impetus and the restart look like. And it's not in several months we have to think about it. It's actually now to make sure that it's a V shape for the economy, but it's an L shape for carbon. And so thank you all. Stay safe, stay at home. All the best for the coming weeks. And hopefully this event happens again, and hopefully it happens live in some near future. So have a lovely weekend, everyone, and see you soon.
Bye.
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 Take care.
Yeah, I just wanted to mention, I answered some of the questions in the type thing. So if you ask the question, have a quick look there. So maybe you find an answer.
Amazing. Thanks a lot.
Welcome.
Bye.
Bye.